On the 14th of April, 2026, Canada's Office of the Superintendent of Financial Institutions, the federal authority overseeing the nation's 8 largest banks along with dozens of federally regulated financial entities, released its annual risk outlook for fiscal years 2026 through 2027. This extensive 72-page report is accessible to the public on OSFE's website, yet mainstream financial media have scarcely reported on it. Buried within the technical jargon of banking supervision lies a sentence directly describing what this discussion highlights. In 2026, we will focus on resilience in periods of stress. Supervisory work will include reviewing contingency funding and recovery plans at banks. We will assess how internationally active institutions consider geopolitical shocks in their plans. Contingency funding plans are mandated documents detailing how banks intend to act if a liquidity crisis threatens their ability to satisfy depositor withdrawals. Recovery plans, meanwhile, outline the internal steps a bank would take should its capital or liquidity erode to the point where normal operations require extraordinary interventions. The mere fact that OSFI plans to examine these documents at major banks during fiscal 2026 to 2027 is not alarming in isolation. Periodic review of such plans is standard supervisory practice. What heightens concern, however, is the context surrounding OSFI's review. The April 14th publication identifies the top 3 risks for Canada's financial system: real estate, secured lending risk, non-bank financial institution risk, and liquidity and funding risk. Just 2 days later, on the 5th of May, OSFI Superintendent Peter Routledge addressed an industry gathering in Toronto, noting that while the system remains sound, the primary vulnerability lies in the speed at which conditions can shift. This phrase, the speed at which conditions can shift, was emphasized as a precise statement about liquidity risk in today's environment. In addition, OSFI's April 14th report revealed that new liquidity adequacy rules, targeting specific retail deposit categories, took effect on May 1st, a Friday. This date coincided with the immediate market adjustments following OPEC's exit from its previous agreements and came just days before the superintendent's public remarks, highlighting liquidity speed as a critical vulnerability. To understand these statements in plain English, it's essential to grasp the mechanics of a bank freeze, a concept seldom explained from a regulatory perspective. A freeze is not an abrupt announcement made midweek. Rather, it is a documented operational and legal protocol embedded in contingency funding and recovery plans. When liquidity stress is detected at an institution, whether through surging overnight funding costs, accelerated deposit outflows beyond modeled baselines, or counterparty credit limits being simultaneously reduced, regulators initiate a contingency funding plan review. The plan itself details the sequence of actions a bank must execute to stabilize liquidity. These measures may involve drawing on collateral prepositioned at central bank facilities, accessing equivalent emergency funding programs, liquidating securities portfolios, and, if necessary, restricting certain deposit withdrawals to control outflow velocity. It is this final measure, temporary limits on specific deposits, that the public recognizes as a bank freeze, formerly termed a contingency withdrawal restriction in regulatory documents. These interventions are time-bound, designed to buy hours or days for liquidity teams to deploy emergency resources without triggering a self-fulfilling crisis. OSFI's liquidity adequacy revisions, which became effective on May 1st, set the parameters for such restrictions by specifying which retail deposit categories are subject to defined liquidity standards. The timing of these rules, alongside the converging market stresses in the U.S., is precisely what elevates concern. The same week, indicators from U.S. regional banks, the Federal Open Market Committee's most split vote since 1992, OPEC's market exit, and warnings from major investment entities converged, creating a regulatory and market environment ripe for coordinated weekend contingency actions. Across the border, the U.S. banking freeze preparation follows a parallel but distinct framework. The Federal Reserve's contingency arrangements, outlined in recent publications, include a confidential problem bank list, Friday night closure protocols, and pre-identified assuming institutions. Key to weekend freeze readiness is the Fed's expansion of discount window access and the Bank Term Funding Program, measures designed to reduce the stigma of emergency borrowing that, historically, delayed liquidity interventions and exacerbated outflows during the March 2023 regional banking crisis. By making these resources less visible yet fully operational, regulators aim to mitigate liquidity stress quietly over a weekend, without alarming markets. These mechanisms are complemented by emergency communication protocols, enabling swift, stabilizing statements ahead of global market openings. Together, the U.S. and Canadian systems operate as an integrated financial ecosystem, with major Canadian banks, Royal Bank of Canada, Toronto Dominion Bank, Bank of Nova Scotia, Bank of Montreal, and Canadian Imperial Bank of Commerce, holding more than $2 trillion in U.S. assets and funding exposure. TD Bank alone ranks 10th among U.S. banks, with over $400 billion in American assets across more than 1,100 branches from Maine to Florida. Its U.S. operations remain under regulatory growth constraints following a 2024 Department of Justice consent order. The bilateral context explains OSFI's focus on internationally active institutions' contingency funding plans. Canada's second-largest bank operates under U.S. restrictions at its largest foreign subsidiary, while OSFI has identified liquidity and funding as one of the top 3 systemic risks. When combined with U.S. regional bank stress signals, this creates a scenario where synchronized regulatory readiness is both prudent and necessary. Canada's specific dynamics further reinforce this preparation. OSFI's data indicates that by early 2026, approximately 76% of all Canadian mortgages are due for renewal before year-end, creating additional liquidity considerations. In such an environment, both countries' regulators are strategically preparing weekend operational measures that are designed to be precise, timely, and minimally disruptive, ensuring that when activation is required, interventions can occur quietly and effectively. The overwhelming majority of Canadian mortgages originated during the low interest rate period from 2020 through 2022. As these loans come up for renewal under current rates, elevated through the Bank of Canada's inflation control cycle, households face a stark payment increase that OSFI has been flagging for the past 3 years. At the M4 World Bank spring meetings in Washington during April, Bank of Canada Senior Deputy Governor Carolyn Rogers highlighted this risk explicitly, describing the mortgage renewal cycle as the central domestic financial stability threat set to peak in the summer and fall of 2026. For an average household renewing a standard 5-year fixed mortgage, the Bank of Canada estimates an additional $1,000 Canadian dollars per month in debt service, a sum that was never included in the original budget. This is not discretionary spending being trimmed. It is mandatory cash flow now redirected from general consumption to debt obligations. These additional payments occur in a context where inflation, at 3.5% to PCE in the US and comparable levels in Canada, has already eroded real purchasing power. On top of that, the Iran war energy shock has imposed further gasoline and heating costs, consuming nearly half of the increase in monthly consumer spending, as documented in recent research. The convergence of mortgage renewal pressures, rising energy costs, and depleted consumer credit creates the precise Canadian household stress scenario that OSFI Superintendent Routledge alluded to, when emphasizing the vulnerability arising from the speed at which conditions can shift. Applying this framework to historical precedents reveals how combined regulatory preparedness, mortgage shocks, and non-bank financial stress can trigger weakened banking system actions. The first historical comparison is the bilateral Federal Reserve and Bank of Canada coordination during September 2008. This episode is particularly significant because it demonstrates simultaneous cross-border stress requiring coordinated regulatory action. When the U.S. financial crisis escalated with Lehman Brothers' collapse on Monday, September 15th, the Bank of Canada and the Federal Reserve established emergency U.S. dollar swap lines, ensuring Canadian banks maintained access to dollar liquidity as global funding markets froze. This bilateral mechanism is the same one that would be activated in a potential weekend bank freeze scenario in 2026. The Bank of Canada can supply U.S. dollar liquidity to domestic institutions through standing swap arrangements without those banks having to engage the Federal Reserve directly. This shared liquidity framework is what renders weekend freeze preparations truly bilateral rather than 2 independent national exercises. OSFI's declaration that it will evaluate how internationally active banks incorporate geopolitical shocks signals that these swap line protocols are under active review, a confirmation of prepositioned operational and legal frameworks being scrutinized today. Check. Verified. Undeniable. The second historical case is the Northern Rock Bank run in the United Kingdom, September 2007. It offers the clearest lesson on the dangers of inadequate preparation. Northern Rock, a British building society heavily reliant on wholesale rather than retail deposits, faced the sudden global freeze of wholesale funding in August 2007, following early cracks in the U.S. subprime market. When the bank sought emergency liquidity from the Bank of England, public awareness on September 14th led retail depositors to queue outside branches in the first true bank run the UK had seen since the 19th century, captured live by global media. Northern Rock was not insolvent. It had adequate long-term assets, but insufficient short-term funding. The accelerated withdrawal of deposits created insolvency, overwhelming emergency liquidity facilities. The regulatory takeaway is clear. Preventing runs before they occur, especially in the digital banking age, is the only effective strategy. OSFI has formally embedded this lesson in its supervisory framework. Weekend bank freeze preparations operationalize it. Tools are reviewed in advance, legal structures established, and withdrawal restrictions can be deployed before any social media post triggers a rapid depositor exodus. Check. Verified. Undeniable. The third historical reference is the Cyprus bank freeze of March 2013, the most extreme and directly relevant example for the weekend scenario. Cyprus, together with the European Central Bank, European Commission, and IMF, enacted a 2-week freeze after determining banks were insolvent due to Greek sovereign debt losses. From March 16th through March 28th, depositors could only access accounts under strict daily ATM limits. Upon reopening, uninsured deposits above $100,000 at the largest 2 banks were converted to equity, a partial confiscation. The Cyprus example is not predictive for the US or Canada. Both systems possess stronger capital, more diversified funding, and robust deposit insurance. Its relevance lies in demonstrating the operational reality of regulatory preparations when activated, showing the actual implementation of contingency funding plans akin to what OSFI is reviewing for Canadian banks under the new liquidity adequacy revisions effective May 1st, 2026. Now, let us clarify what bilateral US and Canadian bank freeze preparations mean for depositors and investors. Precision matters more than alarm. Neither the Federal Reserve nor OSFI has indicated a freeze is imminent. Any announcement itself would trigger the event regulators are trying to avoid. What both institutions have done, through public documents issued within the last 3 weeks, is acknowledge the conditions that elevate liquidity stress risk and formally commit to examining the regulatory tools to address such scenarios. OSFI has identified its top 3 risks: real estate, non-bank financial institutions, and liquidity and funding. It has highlighted the speed of potential deterioration as the key vulnerability. It has implemented new retail deposit liquidity rules effective May 1st. It has committed to reviewing contingency funding and recovery plans at major banks. The Federal Reserve's 2026 risk review notes $36 billion in unrealized securities losses, a 1.45% CRA PD&A, and warnings of sudden massive liquidity drains. The Fed has reduced discount window stigma. Bank of Canada's Carolyn Rogers has flagged the mortgage renewal shock as the peak domestic financial stability threat for summer and fall 2026. Together, these documents represent the most detailed advanced public record of bilateral banking system, stress conditions, and regulatory readiness since the period leading up to the March to 2023 regional bank crisis. That crisis began on a Thursday evening and, for the first affected institutions, largely resolved over a weekend. The next episode, if it arises, will also be managed over a weekend. The distinction between institutions ready for that scenario and those on P to understand the specific OFI risk framework linking Canada's top 3 financial vulnerabilities to the weekend freeze scenario, it is crucial to trace how each risk transmits into a potential liquidity event. This is why preparations are being implemented now rather than postponed to a later quarter. The first of these top risks, real estate secured lending, mirrors the United States' commercial real estate maturity wall, but with uniquely Canadian characteristics that intensify its impact. Canada's residential mortgage market is far more concentrated, predominantly composed of variable rate and short-term fixed rate products. Consequently, changes in Bank of Canada policy rates translate more swiftly and fully into household debt obligations than in the US. When the Bank of Canada enacted aggressive rate hikes in 2022 and 2023 to curb inflation, it did not merely affect the cost of new mortgages. Every variable rate mortgage in the country saw an immediate rise in monthly payments. Simultaneously, the clock began ticking on the 5-year fixed mortgage renewal cycle, which OSFI has documented will reach its apex during the summer and fall of 2026. The pathway from residential mortgage renewal shock to bank balance sheet stress is transmitted through the credit quality of mortgage portfolios. When households face an additional $1,000 Canadian dollars per month in mortgage payments, the likelihood of delinquencies across other consumer credit products, car loans, credit cards, personal lines of credit, increases. This is a household budget shock that spreads across all credit obligations, not just the mortgage itself. Since Canadian banks hold both mortgages and consumer credit products, the resulting stress concentrates within their portfolios rather than dispersing across a broader creditor base. The second top risk, non-bank financial institutions, represents Canada's counterpart to the US private credit redemption crisis. This channel is extensively documented in OSFI's wealth professional analysis. OSFI notes explicitly that Canadian banks' exposure to private capital firms and their portfolio companies has expanded significantly in recent years, forming a material portion of balance sheets. Hedge funds are particularly relevant, employing substantial leverage through repo financing and derivatives. OSFI warns that any increase in funding costs or sudden large margin calls could force abrupt position unwinds, destabilizing markets. Sovereign bond markets are identified as especially susceptible to such hedge fund deleveraging, where dislocations could create spillover effects, straining funding conditions and diminishing liquidity coverage. Federally regulated Canadian banks rely heavily on the stability and depth of these sovereign bond markets, making them the precise channel through which NFI risk could trigger a weekend bank freeze. Forced hedge fund deleveraging directly challenges the liquidity frameworks used to calculate regulatory capital adequacy. The third top risk, liquidity and funding, is the vulnerability Superintendent Routledge highlighted on May 5th, emphasizing the speed at which conditions can deteriorate. Canada's digital banking infrastructure, while enhancing speed and convenience for depositors, also enables far quicker and more concentrated outflows. OSFI's published analysis explicitly notes that digitalization can precipitate sudden and intense deposit withdrawals. The potential for a digital bank run, where transfers can be executed in 30 seconds via mobile apps, defines the specific vulnerability that renders the new May 1st retail deposit liquidity adequacy revisions and contingency funding plan reviews directly relevant to the weekend freeze scenario. When OSFI refers to speed as the key vulnerability, it is describing this 30-second transfer capability as the mechanism capable of transforming a Thursday morning confidence event into a Friday afternoon liquidity crisis, potentially outpacing regulatory intervention. The newly effective May 1st liquidity adequacy revisions now formally govern the contingency withdrawal restrictions designed to manage precisely this scenario. The bilateral dimension of the Canada-US framework carries an additional feature warranting mention, particularly given recent developments not yet widely analyzed in mainstream financial commentary, the actions of Ontario and Alberta in early 2026 regarding U.S. banks. In February 2026, responding to tariff measures imposed by the Trump administration, Ontario and Alberta excluded U.S. investment banks from participating in their provincial bond syndications, redirecting those deals to European financial institutions. This marked the first formal financial retaliation by a major U.S. ally against American banks since the modern era of globalized finance began. The implication for bilateral weekend freeze preparations is nuanced. While swap lines between the Bank of Canada and the Federal Reserve remain legal standing arrangements, unaffected by political approval, activating them amid provincial exclusions of U.S. banks and ongoing tariff disputes introduces a more politically complex context than the straightforward central bank coordination seen in the 2008 and 2020 episodes. The risk is not unavailability, but rather a noisier and potentially more disruptive activation environment compared to the contained technical weekend resolution that contingency planning is designed to achieve. The weekend preparation framework is fully documented, with the regulatory structure public and the bilateral tools in place. The outstanding question is whether these measures will be required, a question informed by the accumulation of verified, sourced stress signals across both countries' banking systems. It is critical to acknowledge a counterargument. OSFI publishes an annual risk outlook, routinely reviews contingency funding plans, and periodically updates liquidity adequacy requirements. Individually, none of these actions is extraordinary. The three risks OSFI identified for 2026 to 2027, real estate, non-bank financial institutions, and liquidity, are consistent with prior monitoring. Canada's major banks remain among the best capitalized, most conservatively managed, and highly diversified in the developed world. In 2008, Canada avoided bailouts that nearly every other major country required. Capital ratios remain well above regulatory minimums, and while mortgage delinquencies are rising, they remain low by international standards. Superintendent Routledge has affirmed that the system remains sound. Yet the counterargument overlooks the specific context in which these routine activities are occurring simultaneously. Contingency funding plans are being reviewed in a year when OSFI highlights the speed of liquidity deterioration as a central vulnerability, during a week when the U.S. Federal Reserve warns of sudden massive liquidity drains from non-bank credit line draws, and in a month when Berkshire Hathaway's $397 billion cash reserve and Warren Buffett's market characterization anchor institutional risk discussions. The routine tools themselves are unchanged, but the environment in which they are employed is far from routine. The timing of the May 1st retail deposit liquidity adequacy revisions, coinciding with OPEC's exit announcement 3 days after the FOMC's most divided vote since 1992, is unlikely to be coincidental. OSFI and the Bank of Canada possess the same data compiled across 30 scripts, encompassing energy crisis trends, banking system credit deterioration, private credit redemption, consumer financial depletion, margin debt cascade risks, and European institutional reallocation, all in more complete form than the public sees, supplemented by confidential examination data. When new liquidity adequacy rules are enacted and contingency funding and recovery plans are reviewed at major banks for fiscal year 2026 to 2027, regulators are acting on a data-informed view that the risks under their mandate are more likely to materialize than at any point in recent years. Preparations remain quiet, Documentation is public, and the weekend is 3 days away.